Hi everyone. Today we are going to discuss question number 1 in 2021 paper. This is related to the company's account lesson. So I will tell you how to start this kind of question. So at first, what you have to do, you have to read what they have asked, right? So ask you to prepare, right? So okay, that here we go. Right. Required. The following financial statements of Eranga PLC for the publication as well. Case 1. Presentation of financial statements. What they have asked you to prepare. A statement of profit or loss and other comprehensive income for the year ending 31st March 2021. Income statements, right? And then statement of changes in equity for the year ending 31st March 2021, changes in equity, right? So then statement of financial position as at 31st March 2021 balance sheet, right? So these are the three statements that they have asked you to prepare. With that knowledge, we are now we are going to read the question, right? Okay, now here that at first you see that you have been given a typical trial balance. Okay, let's read the question. The summarized trial balance of Eranga PLC as at 31st March 2021 is given below, right? So description is given. Property, plant and equipment, right? So land at cost 10,000. Please keep in your mind figure sign 1,000, right? So that you have to be careful when you are preparing your financial statement, because here they have given figure sign 1,000, right? So, okay, land at cost 10,000, buildings at 18 at cost 18,000, office equipment at cost 7,500, motor vehicles balance. But here they have not mentioned at cost. Why? I think there may be an adjustment. So okay, I don't know. We'll see. Motor vehicle balance 20,000. Accumulated depreciation as at 31st March 2021. Right. So that means that accumulated depreciation also they have given, but these are not opening balances because these are the closing balances. That means that the depreciations has been calculated by them, right? So that means you need not to calculate the depreciation expense. We'll see, right? Okay, buildings 3,000, office equipment 1,500, motor vehicles 6,500. Then inventory debit balance 4,250, trade receivable 7,500, trade payables is also given 4,250, right of use asset to 2,500, cash and cash equivalents 500, stated capital ordinary shares 38,000, stated capital ordinary shares 38,000, credit balance, retained earnings as at 1st of April 2021, opening balance 12,500, sales 60,000, cost of sales 38,500, that they have calculated the cost of sales also, and administrative expenses 6,800, distribution cost 7,200, finance cost 1,200, other expenses 600, income tax paid, right? So they have made the payment of income tax 1,900, provision for income tax as at 1st of April 2021 600, right? So then now okay, now we are moving on to the additional information, right? So here they have given before preparing the financial statements for year ending 31st March 2021, adjustment have to be made for following, right? But they have said, and that when they are preparing the trial balance, these things have not been considered, right? So then they ask you to consider following when you are preparing the statement of the financial statements, right? Okay. Okay, the next step is that you have to prepare these three statements, right? So, okay, we see how to prepare. At first, you have to, they have asked the statement of profit or loss and other comprehensive income for the year ending 31st March 2021. That you have to prepare this as per the LKS 1. Okay, that's a standard format for that. Then that is what the standard format is. Now you see Eranga PLC statement of profit or loss and other comprehensive income for the year ending 31st March 2021. This is the standard format of a statement of profit or loss and other comprehensive income as per the LKS 1. Now you see, right? So then sales, cost of sales, gross profit, other income, distribution cost, administration expenses, other expenses, finance cost, and then profit before tax, income tax expenses, profit for the period, and other comprehensive income also uh, should be recorded, and then total comprehensive income, right? So this is the format of statement of income, profit or loss and other comprehensive income. So this can't be changed, and this is as per the LKS 1. The next one is change the statement of changes in equity. This is the format of that. Eranga PLC statement of changes in equity for the year ending 31st March 2021. Then you have to record the opening balance, and then total comprehensive income, interim dividend, and balance sheets. But if any other thing, if you want to record any other thing, then we'll see when at the time when we are reading the question, right? So okay, then statement of financial position, you see Ranga PLC statement of financial position as at 31st March 2021, because this has been prepared uh, for the specific date. That's why we have named it as at 31st March 2021. Okay. Now current assets, property, plant and equipment, right of use, that non-current assets. At first we have to take the non-current assets, then current assets, and you know what are the current assets. If there is any other asset, then you can record, doesn't matter. Then equity, uh, stated capital ordinary shares, reserves, revaluation reserves and retainers. Actually I already prepared this because otherwise it will take time. And then non-current liabilities, lease liability, then current liabilities, right? So here it should be liabilities, sorry, please. Lease liability, tax payables, income tax payables, audit fee payables, fees payable, and total equity and liabilities, right? So this is the format of statement of financial position. Okay, now all three statements are prepared. Now we are moving on to the adjustment number one. Now we are moving on to the adjustment number one, right? So okay, office equipment costing Rs 1002 million was purchased on 30th June 2020, and it has been properly accounted. That there is no problem, but they have accounted it properly. This is the only purchase as to property, plant, and equipment during the year. This is the only purchase to PPE. And okay, that is what they have given, right? So this is relating to the property, plant and equipment note. We'll see how to prepare note for PPE. Okay, I already prepared it. This is the note you have to prepare for property, plant and equipment. Here there are two things mainly you have to identify: cost and accumulated depreciation, that you have to uh, show them separately, right? So these are the assets you have been given, that I have taken these from your trial balance, and then opening balance, additions, revaluation surplus, and disposal, and accumulated transfer to accumulated depreciation. But if there is any revaluation relating to the depreciable asset, then we have to transfer the accumulated depreciation at the time we are calculating the value of revaluation, and then disposal and closing balance of the value of those assets, and then accumulated depreciation. Then opening balance should be recorded here, and additions, and transfer the accumulated depreciation, and then disposal balance as at 31st March 2021, and carrying amount. right? So this is the format for uh, note which is related to the property, plant and equipment. Okay, now you know that they are talking about the property, plant and equipment, right? So okay, we'll see what is the cost of that property, plant, sorry, office equipment, right? They have given 7,500. Is this a opening balance or closing balance? Yeah, this is the closing balance because the balance are given as of 31st March 2021. So therefore, uh, now that they have not given the opening balance, then we have to uh, calculate and we have to find out what is the opening balance of this office equipment, right? Okay, now uh, in the adjustment they say that there is a only purchase. What is the value of that purchase? 1002, right? So it is simple as that. Then uh, you know the closing balance of the property, plant and equipment is 1005, and there is a only purchase. The value of that is 1200. Then the opening balance should be 1500 minus 1200, 6300. It is simple as that. The opening balance of the office equipment is 6300. In addition, 1200, right? So that how 7500 comes, right? I think you can understand that. So then, but we can't record this because there is a revaluation which has been given under the second adjustment. You see, the land and office equipment were revalued for the first time at their market price on 31st of March 2021 as follows, right? So then they have revalued land and office equipment. And the land value is 15,000, office equipment 5,000. Okay, at first we take the office equipment, right? So now you see, uh, now the value of the cost of office equipment is 1500. It is clear, right? And accumulated depreciation, right? So accumulated depreciation for the office equipment, that closing balance they have given. What is the value of that? Office equipment 1500, right? 1500. What is the net value of office equipment? 7500 minus 1500. This is the net value. This should be the net value of or carrying value of the office equipment. Now, what happened that they revalued it and they say, no, no, the value of the office equipment, the market value of the office equipment is 5000, right? So 5000. Then what happened? The value of the office equipment has gone down by 1000 rupees. I think that is lost to the company. Then we have to record it as a revaluation deficit. And also the depreciation expense. Now, depreciation expenses also should be transferred to the office equipment account, right? So how we transfer, and then we have to remove that minus 1000, and this also need to be transferred to this account, right? So it is like this, and now you see, right, the value of the office equipment, now it should be 5000, right? So that's what they have asked us you to do, right? So here there is no accumulated depreciation because that they have revalued the asset on 31st March 2021, right? Okay, now the next the depreciation deficit. this should be taken into the P&L also. That should be taken under the other expenses. So then what we have to do, that we have to record this under the workings, right? So the revaluation deposit under the other expenses. It is the value 1000, because this should be taken into the P&L, because this is an expense, right? And then land they have value at 15,000. So there is no depreciation, accumulated depreciation relating to the land. What is the value of the land? Yeah, 10,000. 10,000. And we think that opening balance also 10,000, because that they say there is no purchases uh, apart from this purchases of this equipment. So then we can think that closing balance is equal to the opening balance, and there is no depreciation. But they say the closing value of the asset, of the land, now the market value is 15,000. Then what you have to do? Then there is a surplus 5,000. Right, so there is a profit. Right, so then that should be recorded under comprehensive income. How? Revaluation. Revaluation plus 5,000. And also this should be recorded under the changes in equity also. Right. So, okay, now we are done with the question adjustment number 2. Now we are moving on to the adjustment number 3. Okay, adjustment number 3. The depreciation for the buildings and office equipment for the current year has been correctly calculated and accounted. So there is no problem with that, because they have calculated it in correct manner. So there is no problem with that. So okay, then uh, adjustment number 4. A motor vehicle was sold on 1st of October 2020 for rupees 4,000. This motor vehicle had been purchased on 1st of October 2018 for rupees 5,000, and the company depreciates motor vehicles annually at 20% on cost using a straight line method. The cash received by selling the motor vehicles has been debited to the cash account and credited to the motor vehicle account. No other accounting entry has been made in this respect. The depreciation on motor vehicles for current year has been calculated and accounted for the whole year based on the opening balance of the motor vehicle account, right? So okay, now that they have that, it is simple as that, right? So simply what they have done, they have sold a motor vehicle. The value of that motor vehicle is 5 million, and they have sold it for 4 million, and they have received the cash. What they have done, they have debited the 4 million to cash account and credited to the motor vehicle accounts. That they have done so far. So that is the wrong entry actually, right? So now we have to understand. It is like this. I prepared this. Now our financial year starts from 1st of April 2020. 2. The closing date is 31st March 2021. This is our financial year. You know that. And we have sold this motor vehicle on 1st of October 2020, and the mid of our financial year. And this has been used for 6 months in our current financial year. And also this machine has been purchased on 1st of 2018 and sold on 1st of October 20. That means the motor vehicle, totally this motor vehicle has been used for 2 years, right? Why? they have purchased on 1st of October 2018, sold it on 1st of October 2020. But it's simple as that. And also they have given the sale value, that is rupees 4,000, and the cost of this motor vehicle is 5,000. They have purchased it on 1st of October 2018 at 5,000. And depreciation rate also is given 20%, and straight line method is a straight line method, right? So I think if you can understand this information well, I think it is easy for you to make this adjustment, right? Okay, now they have sold this asset. Then what they have made a wrong entry at the time they sell this motor vehicle. They have debit cash 4,000, credit motor vehicle account. That's wrong, right? So here in the trial balance they have given motor vehicle balance as 20,000, right? So 20,000, how they have taken this 20,000, and they have debited this 4,000 to the opening balance, and then sorry, credited to the opening balance, and then they have taken the 20,000. Then opening balance should be 24,000. Then opening balance of the motor vehicle is 24,000. Then they pass this journal entry, this entry, and they credited 4,000 to the motor vehicle account. Then balance comes as 20,000. So then opening balance should be the, or opening balance of the motor vehicle should be 24,000, right? And also then they have, now we have to dispose the asset motor that particular motor vehicle, right? So what we have to do, we have to dispose, and we have to remove 5,000 from the motor vehicle account, and that should be debited to the disposal account, right? So then depreciation, how to calculate the depreciation related to this particular asset, particular motor vehicle. This has been used for 2 years, right? So the value cost of that motor vehicle is 5,000, depreciation rate is 20,000, number of years used 2 years. So then 5,000 into 20% into 2,000. This is the accumulated depreciation is relating to that motor vehicle, 2,000. That should be credited, debited to the accumulated depreciation account. That means minus, and credited to the disposal account. And then they have sold it for 4,000. What is the entry? The cash debit, disposal account credit. Now easily we can find out the profit through the disposal account. What would be the profit? 1,000. By selling the motor vehicle, the company has earned a profit of 1,000, right? So this should be recorded under the other income, right? The income gain on motor vehicle, 1,000, right? So here also you can see the cost of the asset 5,000, accumulated depreciation 2,000, carrying amount is 3,000, sale proceeds 4,000, disposal proceeds, then 1,000 gain on disposal, right? So that should be recorded under the income, right? So it is simple as that. And then we have to calculate the depreciation expense also. for the motor vehicle. Now we have to calculate the depreciation expenses for the motor vehicles also. Then here they say the depreciation on motor vehicles for the current year has been calculated and accounted for whole year based on the opening balance of the motor vehicle account. So that is raw. Why? You see the opening balance of the motor vehicle is 24,000. 24,000 into 20%, 4,800. That is what they have calculated. But that is wrong. But you see that here they have mentioned that 4,800 as a depreciation expenses for motor vehicle. Why this is not correct? Here there are two motor vehicles and 5,000 and 19,000. This the 5,000 worth of motor vehicle has been used only for 6 months. Therefore, we can't calculate the depreciation expense for whole year. And 19,000 motor vehicles are okay that they have been using for whole year. So then for 19,000 motor vehicles can be depreciated for whole year, but 5,000 motor vehicle expense depreciation expenses for the 5,000 motor vehicles should be calculated only for 6 months, right? So here just like this, then 20% can apply. Here 20%, and here 5,000 into 20% divided by 12 into 6, only for 6 months. Here it doesn't matter, we can by 20,000, then total depreciation expenses should be 4,300. So here they have calculated 4,800. That should be reversed. How we can do that? So here we have to record additions, depreciation 4,300, and under the workings we have to reverse this depreciation expenses as over provision of the depreciation, because you know that the depreciation for the motor vehicles has been recorded under distribution cost, then this 500 rupees should be removed from that depreciation expense, right? So it is simple as that. So now we are done with the uh, adjustment number 4. Now we are moving on to the adjustment number 5. Okay, look at the adjustment number 5, that here the composition of administrative expenses and distribution cost is as follows, right? So they have given the breakdown of administration expenses and distribution cost. So what we have to do here, for the time being, we just take the total of uh, these expenses, right? So here the total administrative expenses 6,800. We take this total administrative expenses 6,800. We record here plus 6,800, and uh, distribution cost balance 7,200, and some of these expenses need to be recorded under note number 2. We'll take it later, and now after that, now we are moving on to the uh, adjustment number 6. And here the interim dividends paid to the ordinary shareholders is shown as other distribution cost, right? So what they say, that they have made the payment of interim dividend, and this has been recorded under the administrative expenses. Name is they named it as other distribution cost. sorry, it has been recorded under the distribution cost. Sorry. So actually we know the dividend payment of dividend is not a expense which is recorded in the P&L. That should be recorded in the changes in equity. So what we have to do is we have to remove this 400 rupees from the distribution cost and need to be taken into the changes in equity. Okay, we'll see how to do that. Here they have 7,000 to here interim dividend should be removed is yes 400, and that should be recorded in the statement of changes in equity under the retained earnings, because this can't be recorded in the P&L. We know, as you studied, as you learned, you know the dividends, payment of dividends, which is which should be recorded under in the changes in equity, right? So a statement of changes in equity, right? Okay. Now, okay, we are done with the adjustment number 6, and okay, now look at the adjustment number 7. No entry has been made for the audit fees of rupees 300,000 payable as at 31st March 2021. You know the audit fees that should be recorded done in the P&L under the administrative expenses, but here they have not recorded that expense. So then we have to record it, because this is a simple adjustment. How we can do this? You know, here the workings, we have to add this to the administrative expense 300, and we have to record this under the in the balance sheet also, in the changes in the statement of financial position, because this is a liability. Audit fee payable. Okay, now we are done with adjustment number 7. Now we are moving on to the adjustment number 8. Okay, now we are moving on to the adjustment number 8. Okay, the company entered into a lease agreement on 31st March 2021 to obtain the right of use of a plant for a period of 5 years, right? So the company has entered into a lease agreement, right? So on 31st March 2021, you know that the closing date of our financial year, you know that our financial year starts from 1st of April 2020 to 31st March 2021. That is our financial year, right? Okay. Now, on that date, they have entered into the lease agreement to purchase a plant, right? So the lease period is also given 5 years, right? So we have to simplify this, right? Date, agreement, date, 31st March 21, and period 5 years, this period, right? So in for the period, according to the lease agreement, 2.5 million was paid on 31st March 2021 as the down payment. They have made a down payment of 2.5 million, right, rupees, right? So they also it's we take figures are in thousand, so because that's how we have prepared our financial statements, right? So okay, okay. Now, okay, now they say 5 annual lease installments of Rs rupees 971,000 each should be paid over the lease term end. The first installment is due on 31st March 2022. After the 1 year, it is due, right? The total interest payable over the lease term is 1,355,000, which includes rupees 420,000 interest for the year ending 31st March 2022. Only the down payment has been recognized as a right of use asset. No other entry has been made in this regard, right? Okay. Now you know that the interest component is also given, and here now we have to calculate the lease liability, right? So they have given the number of years, and the installment also they have given 971, right? And 5 years, and now we can find out total liability, the lease with the interest, and how we can calculate 971 into 5, right? This is the total amount need to be paid over the 5 years time period, right? So here the interest component is included in this figure that need to be removed. How can we remove? They have given the interest amount 1,355,000, right? Interest, and then we can get the value of lease liability, right? 300 3,500, right? So now we know the value of the asset, right? So down payment is 200 and 2,500, lease liability 3,500. Now easily we can get the value of the asset, plant 6,000, right? And also this is okay. Now they have recorded down payment, and but this has not been recorded. What should be the journal entry for this 3005? Then asset debit, lease liability credit, right? So now lease liability, right? So this is the if you want I can show you the journal entries also. Now here they have record right of use asset. At first they have made the first entry use asset. Right? So this is the first journal entry. Already they have made this entry, then it doesn't matter. Now we have to record the lease liability, right? So then how we can record that? Like this, right? So now it is simple as that. Now here already they have recorded this journal entry. Then value of the right to use that asset is 2,500. Now we added 3,500 because we have a lease liability. Then the value of the right to use asset is 6,000, right? So this should be recorded in the statement of financial position, right? So there is a note for that. Down payment 2,500, lease liability 1,500, the value of that is 6,000. We will take this into the statement of financial position later. Now the next question is how to record the lease liability. Now there is a problem, right? So the first installment will be due on 31st March 2022, after the 1 year time. That should be recorded under the current liability, and balance need to be recorded under the non-current liability. Then how can we divide this figure into two? Then it is easy for us because the interest component which are components which are relating to these have been given, right? So here you can read the total interest payable over the lease term is 1,355,000, which is include 420,000 interest for year ending 31st March 2022. Then this is the interest amount which is relating to the first installment. So then we can calculate the lease liability which is relating to the first installment, right? So now first installment is 971, interest amount is 420 they have given, and that should be deducted from the installment amount. Then we can get the lease liability which is relating to the first year is 551. This should be recorded under the current liability in the statement of financial position. And now the total liability is 3,500. Out of that, 551 is relating to the first year first. So then the balance part, it is easy for us to calculate. How we can calculate? 350 minus 3,500 minus 551, 2,949. This should be recorded under the non-current liabilities. Lease liability. 941, sorry, 2,941. That is how it should be recorded. Now I think you can clear. So here what we have to do, here that already they have recorded this journal entry, then doesn't matter with that. And now we have to calculate the lease liability. They have given the value of installment, and which need to be paid over the 5 years time period. Then what we have to do, then we can calculate the total liability. How? Installment into number of years, 971 into 5. Then the total value is 4,855. This includes that the interest component is included in this figure, that should be removed, that is not recorded in the statement of financial position. So then how can do that? So we have they have given the interest amount, that need to be removed, and then we can get the value of lease liability as 3,500. So what we have to do, we can add this to the value of right to use asset. This is the journal entry for that. Right of use asset debit, lease liability credit. Okay, now we are moving on to the adjustment number 9, income tax adjustment. Here they say income tax paid includes 500,000 paid for the previous year and the tax paid for the first 3 quarters of the current year. The income tax payable for the last quarter of the current year was estimated as 200,000, right? So now they have given a breakdown of income tax. So okay, we'll see uh, what is the income tax payment. Income tax paid 1,900, right? So now they have paid 1,900 during the year, right? And here they say out of 1,900, 500,000 paid for the previous year. So this is not this 500,000 is not for the current year, right? So okay, and what would be the amount for current year? 1,900 minus 1,400. This has been paid for the current year, right? And also not for the whole year. This has been paid only for the first 3 quarters. Clearly they have mentioned, right? Income tax here they say tax paid for the first 3 quarters of the current year. This is the tax liability only for the first 3 quarters. For the last quarter, it is 200,000. It is also given, right? So then 200. Then what would be the liability for total whole year? 1,600, right? So this is the income tax expense for the current year. This should be taken into the note 3, right? So expenses 1,600. And also for the previous year, 500 has been paid, right? But they have provided how much they have provided for the previous year, last year? 600, right? So they have provided 600. They had taken into the P&L in previous year the 600 rupees, right? So 600. So but for the uh, for that year, the liability was only 500. So then there is a over provision here. What would be the over provision? 500, sorry, 500 minus 600 minus 500 rupees. This is the over provision that should be adjusted in the current year. So now we can't go back and adjust. So then we have to adjust this in the current year as over provision. We have to deduct this 100,000 from our current year expense, right? So then income tax expense would be 1,500, right? Okay. And also they have not recorded the 200,200 which is relating to the last quarter. So this is payable. So that therefore this should be taken into the statement of financial position, should record under the current liability as a income tax payable. Right. Okay, now it is done. So now we are moving on to the next adjustment. Okay, now we are moving on to the last adjustment number 10. Okay, here we go. The financial statements of the company were authorized to issue by the directors on 31st May 2021. Right, financial statements were authorized by the directors on 31st May 2021, and following events took place prior to this date. Right, these events have been happened between 31st March 2021 and 31st May 2021. Within these 2 months time period, these have, so we'll see. A trade debtor of the company was declared bankrupt by the court on the 1st of May 2021. The trade receivable balance shown in the trial balance as at 31st March 2021 includes rupees 600 receivable from this debtor. Right. So one of a company's debtors was bankrupt, right? So now we know that we are unable to collect this money from that particular debtor. So that has been declared by the court also. So that clearly they have mentioned. So then what we have to do, we have to remove that balance from our debtors balance, and for that then we know that we can't recover that money, that is expense to the company. So actually what has happened, that our debtor balance need to be impaired. So what is the amount? 600. So then we have to deduct that 600 from our trade receivable balance, and that expense should be recorded in the P&L as impairment allowance, right? So because our data, one of our data has been impaired, right? So then how can we do that? So here you see trade receivable balance is 7,400, right? So what I have to do is we have to remove trade receivable 7,400 minus 600, then balance is 6,800 should be recorded in the statement of financial position, and also that 600 should be taken into the P&L, and that should be recorded under the distribution code cost allowance for impairment. 600 is an expense, and then it's okay. And we'll see the second adjustment under the 10. Yeah, a building with the carrying amount of rupees 5 million was fully destroyed due to a fire occurred on 15 May 2021. Right, one of a building of the company has been destroyed due to a fire occurred. Right, so that has happened on 15th May 2021. Right, so therefore, but however this has for this date 31st May 2020 authorization date. So then what we have to do, then we have to record this, we have to disclose this, just disclose, no need to adjust, but we have to disclose this, why this has happened prior to the authorization date, right? So then we have to disclose this. How we can disclose that? This is under the note number. Now we'll see last note 2, okay, 6. Then we can say this should not be adjusted. So then just event, we can say building with the carrying value or amount of rupees rupees 5 million was destroyed to a fire occurred. Occurred. If you want, we can say the date on 15th May 2022. Okay, everything is done. Right. Okay. Now we'll see what we should do next. What we have to do next, what we should do, then we have to take all the balances which have not been taken yet into our financial statements. Okay, for that, what we have to do, we have to read the trial balance from top to bottom like this. Here, property, plant, and equipment 10,000, property, plant, and equipment, land at cost we have taken, buildings at cost we didn't take. So then we have to take the value of building, right? So we have to record that in the PPE note, right? So building 18,000, because 18,000 opening balance, there is no movement. The closing balance is also 18,000. It's okay. And second one, office equipment we have taken. And then motor vehicle, the balance of the motor vehicles also has been taken. And then accumulated depreciation, buildings we didn't take. These are, please keep in your mind, these are closing balances. So then we have to take uh, accumulated depreciation, buildings 3,000. And okay, then how we can get the opening balance here. Depreciation for the buildings for the year, depreciation expense 900. Then easily we can get the opening balance by deducting the 900 from 3,000. So this is the opening balance of accumulated depreciation of buildings. And okay, now next, buildings, office equipment 1,500, office equipment accumulated depreciation. Okay, now we have to find out depreciation for the office equipment 750. Okay, addition 750. This is the depreciation expense for the year, and total is 1,500. Then opening balance also 50. 750 plus 750 comes to come as 1,500. Okay. Because this motor vehicle office equipment has been revalued, so therefore no closing balance for accumulated depreciation of office equipment. And next, okay, motor vehicle, okay, opening balance, additions for 3, disposal 2. It's okay. Now inventory 4,250 need to be taken into the statement of financial position. Inventory 4,250. Then trade receivable we have taken this. Trade payables 4,250 need to be recorded under the current liability. Trade payable amount is 4250. 4250. Then right of use asset, we have taken that. Cash and cash equivalents 500. Cash and cash equivalent 500. And then cash and cash equivalent, okay. Stated capital ordinary shares 38,000 should be taken into the changes in equity, statement of changes in equity. 38,000. And retained earnings, opening balance 12,500. Retained earnings 12,500, which should be the closing balance. Also, because there is no share issue. And then sales 60,000. 60,000 sales should be recorded in the income statement. And then cost of sales 38,500. 38,500 adjustment. And then administrative expenses, we took all, we took that. Distribution cost, okay. Finance cost 1,200. And finance cost, okay. The expenses distribution directly we can take into the P&L. 200. And other expenses 600. There may be adjustment for that. 600, balance 600. And the income tax, okay. Provision for income tax is also okay. Now, okay, everything is okay. Now we have to pick out this. And from where we will start? Okay, we go with the notes. Now you see the note for property, plant and equipment. Here you can see the carrying value of property, plant and equipment is 50,000. Now you know the how we can get this amount, that this is the cost, total cost 57,000, and the total accumulated depreciation is 7,000. By deducting the accumulated depreciation from total cost, we can get the carrying value of the property, plant and equipment. That need to be taken into the statement of financial position. So, okay, now the value of the carrying value of the property, plant and equipment is 50,000. If you want to see the details, then you can go to the note and see. Then the value of the right of use asset, now you can see that also 6,000. That also needs to be taken into the statement of financial position. And like this. Now okay. And now we have to take all the expenses, right? So P&L, other income, there is a note for that. We'll see other income. And gain on disposal of motor vehicle, it is 1,000. And then distribution cost, you can see the total of distribution cost. Total of the distribution cost, you can see. 6,900. Administrative expenses 7,100. Other expenses 1,600. Right. Okay. Now all these things need to be taken into the P&L. Administrative expenses 1,500 and other expenses 1,600. Right. Okay. Now this should be figures. Okay. Now we can get the gross profit by deducting the cost of sales from sales. The gross profit is 21,500. Then we have to add other income and deducting all these expenses, right? So then we can get the profit before tax. Okay, 5,700. Then income tax expenses also calculated, and here you see 1,500. That should be deducted 1,500. Profit for the period can get calculate, then 4,200. This is the revaluation surplus, and then total comprehensive income is 9,200. Right. Okay. Now the profit for the period should be taken into the changes in equity. Please keep in your mind, we will never take this amount into the changes in equity statement of changes in equity, because this has been this amount has been recorded in the changes in equity separately. Therefore, we need not to take this amount because we are getting this 4,200 into the statement of changes in equity. Right. Okay. As a comprehensive income. Sorry, as a profit for the period to the retained earnings. Then we can get the closing balance of all items of this retained earnings, revaluation, reserves, and we want, you can get the total of these also. In this way, right? Nothing is okay. Now what we have to do, we have to take all these closing balance into the statement of financial position. Right. Okay. Valuation 38,000, reserves, revaluation reserves 5,000, and value of the retained earnings 16,300. Now we can total balance sheet. Okay, this tally with the 67,550, 67,550. Okay. One thing I want to remind you, but here under the note 2, profit before tax, there are some specific expenses you have to clearly mention, right? So under the note 2, right? So then these are the expenses. Directors remuneration, right? So here they have given directors remuneration What is the amount? Directors P 1200. Audit fee. What would be the audit fee? Yes, 300. Audit fee 300. Here they have mentioned the audit fee. Yeah, no entry has been made for the audit fee is 300. Then note that 300 also need to be shown under note 2. And the depreciation expense, easily we can get this from the PPE note, PPE working like this. Total depreciation expenses 5950 5950 950. And allowance for impairment, remember, that is 600. And a revaluation deposit recorded under other expenses, that is 1000. These things need to be shown separately under the note 2 because that is a requirement of the LKS 1. Therefore, you have to record all these expenses separately under the note 2. Now, okay, everything is done. So, okay, then we will meet up with the another question. Okay, thank you very much.